Now, the question everybody has is, are we going to see a real estate crash? Well, in order to answer that question, you got to first define what is a crash. And in the most kind of technical sense, a crash is when you see more than a 20% price drop. Under 20% is considered a correction. More than 20% is considered a crash. So what would it take for real estate prices to crash? Well, obviously, a correction wouldn't be a big surprise. I think everybody is anticipating some sort of correction in the housing market at some point, whether it's 2022 or 2023 or 2024. I mean, it's impossible to predict when. We can't predict what government regulations are going to come out, how they can change things, and what can happen with interest rates. I mean, there's so many different factors that can affect it, which are out of our control, which is out of the market's control, unfortunately.
Historically, they correct about every 10 years, so we're several years overdue at this point. Do you think it's the pandemic really propped up the housing market, kept it obviously at historically high pricing? Without the pandemic, do you think the correction would have happened already? I guess would be my simple question.
Well, it's hard to say because 2019, we were kind of going in that direction. We were already slowing as an economy. But then we saw the interest rates get cut in 2019. I think the Fed cut them 3 times in 2019. So we were trying to prop up the economy, which was supposedly the fastest growing economies of all time, even though we were still kind of slowing. So we were starting to see the effects of a slowing economy, but then we started pushing it. So it's hard to answer that because there are what I call it the X factor. Things that are out of control, government regulations, things that the Fed does, which sometimes we can't predict, or a lot of times we cannot predict. And those can have a real effect on the economy. And it's weird because in a free market, they shouldn't. But this is the world that we live in. But are we inflating it more? Absolutely. I mean, it's if we keep making home prices blow up with cheap debt, and then you want to start raising debt, well, then how are people going to be able to afford these higher prices? Because the affordability for a home comes down to 2 things. It comes down to the house price and mortgage rates. And right now, homes are, in some people's eyes, cheaper than they were a couple of years ago because you can get the same home on a lower monthly payment because interest rates are so much less. And so, it's hard to kind of see what is going to be the turning factor. We have home prices way up here, mortgage rates way down here. If mortgage rates start to go up and home prices stay up here, you're going to see a real affordability crisis, even bigger than we have right now in the housing market.
Yeah, so I think, just to kind of tie all that down, it's interesting because people that are kind of outside looking in at the housing market are kind of what makes it kind of ebb and flow the way that it does. Don't have this kind of granular approach to it. It's a tangled web. I mean, there are just so many factors that go into it. And right now we're at really unprecedented times. I don't think many of us out here that are walking the earth right now have been through the bubonic plague, or major pandemics like that, of course. So, obviously it got everyone on their heels and they were reeling, and now it's like, how do we come back from it? I want to touch later on in the episode your thoughts on whether or not the pandemic, is it going to permanently affect our economy? But I want to stay on the real estate for now. But it's important for people to know that not only, housing prices, mortgage rates, government interaction, government subsidies, the stimulus has affected the housing market. Obviously, the supply and demand, the supply chains, all of those variables really have gone into this melting pot, if you will, and that has left us where we are today. So even people that are out there doing all the research, obviously yourself as much or more than anyone, no one knows exactly what's going to happen because we haven't seen it before. And I want to touch on, 2007, also here later on in the episode, but right now, mortgage applications are down, right? Month over month, inventory is increasing. Is that an indication? Now, you and I are both from the same school. I'm not anticipating an absolute crash. It's not going to go here and then just go straight down. It's going to be a little bit more of a controlled kind of slow growth trajectory as opposed to straight up. So you and I are aligned with that. But even, that kind of tapered off growth can turn south very quickly. Obviously, what are your thoughts on that? Is that kind of ebbing towards, a potential, not necessarily catastrophic crash, but obviously that slower growth?
So yeah, to 2 points to that. We don't have the same factors that we did prior to the 2008 crash. We don't have the same subprime lending, and the same ninja loans and all the other same factors as before 2008, which is good news for the economy. The second thing regarding mortgage slowdowns, I mean, people are turning away from the housing market because they see housing prices. And the second thing is we are actually seeing the opposite of 2008 in the sense of people are not able to get mortgages because homes are not appraising. Wall Street Journal just did a recent write-up on this, where if I list a home for $300,000 and somebody makes an offer to buy it for $330,000, I'm going to accept the highest offer. Let's just say that's $330,000. Well, now the bank comes out and they appraise it. The appraiser might come back at $305,000. So now the buyer who wanted to buy the home for $330,000, who might be able to afford a $330,000 home, can't get appraised for $330,000. And unless they can come up with the extra cash, which a lot of people can't, now they're not going to be able to close on that home because the bank says we're not going to be able to fund you. And this is what we're seeing happen a lot right now because people are just, they're overbidding from homes according to the banks. And because of that, banks are not willing to lend to some people. Then you have people that have gone through a lot of bidding wars and they're like, oh man, I'm tired of this. Let's just wait it out. And then you have people that are just, they look at the home prices and they're saying, screw that. I'm not going to pay this much money for a home, or I can't. And so, there's a lot of factors into that mortgage application. And it also kind of varies on mortgage rates. It's weird because I'm friends with a lot of bankers. I want to get their insight on what's going on because I feel like that's the best way to understand. And what you see is mortgage rates go up. You'll see, a month ago, mortgage rates started to go up pretty quickly and mortgage applications fell fast. And then right now, or a few days ago, when I was checking, mortgage rates came right back down to below 3%. And why are they doing that? Because every time they try to raise mortgage rates, people stop applying for mortgages. I mean, it's our housing market is so reliant on these cheap mortgages that even if they try to raise interest rates a little bit, people turn away. And that just shows you what's going to happen when the Fed says, okay, we're going to raise interest rates, and then mortgage rates have to go up. What's going to happen? I mean, and if home prices keep going up between now and then, I mean, it's going to be interesting. It's impossible to predict, but I mean, people are buying homes because of cheap mortgage rates, and that's the only way they're able to afford these higher house prices. And unless we see a magical rise in wages between now and then, it's hard for me to think how people are going to be able to afford that, along with the higher cost of living. I mean, prices of everything are high, man. Try to buy a car right now. It's not easy. Everything is backed up and you have to pay premiums on everything. And so it's getting harder and harder for people to afford things.
Mm-hmm. Yeah, no, great answer to that. I talk to a lot of folks as well, and folks that aren't necessarily, I wouldn't call them not in the know, but a common phrase I hear is, oh, it's going to be 2008 all over again, right? And
no.
Just in kind of a summary, define the difference in the marketplace from 07, 08, pre fallout, pre-crash, and then during the crash compared to current day. Just for, I wouldn't call them the layman, but just kind of in a nutshell, what are the differences there? Because there's very distinct differences between now.
Sure. Well, let me start by saying this. Home prices the housing market futures is very uncertain. But for people who are looking to buy a home, that's okay. Just make sure you can buy what you afford. I'm a real estate investor. I'm still buying properties. I'm just being way pickier now than it was before because it's way harder to find a good deal. And so it's just be smart with what you buy, and spend some extra time doing research, and don't overpay. Don't get emotional. I mean, that's the reality, because we don't know how long whatever's going on will last. It's impossible to predict that. Prior to the 2008 crash, I mean, we had a few things happening. We had first a boom in variable interest rate mortgages, which meant if you go out to buy a home it might be a 5% interest rate mortgage, but you get to come in on a 1.99% teaser interest rate for the first 3 years or 5 years. And then after that teaser rate, then mortgage rates go up. And there was a lot of behind the scenes things going on where bankers would really just advertise a teaser rate, and people were not financially educated, or they were lied to, whatever it was, where they didn't know how much mortgage payments would go up by. And bankers always told you that, yeah, mortgage rates will go up. And if they do, if it becomes too expensive, don't worry, you can just refi out in 3 to 5 years or 7 years, and then you could just lock in a cheaper interest rate mortgage. So everyone saw the upside, but no one saw the downside. Then you saw the growth of subprime mortgages. So people who could not qualify because of the credit score to buy a home, you could now go out and buy a home, because in the bank's eyes and in the government's eyes and in the world's eyes, home prices only go up. And the government was really pushing home ownership for everybody as the solution and as the cure to poverty and building wealth. Home ownership needs to be a right for everybody. And this is kind of, it's maybe a little bit extreme, but that's kind of the direction that they were going, that everybody needs to own a home, or it should at least be accessible to everybody. Then you saw the growth of ninja loans. No income, no job, no asset loans. And what that means is, I don't got a job, I don't have any assets to my name, but I want to buy this $300,000 home. And the bank would say, okay, sign this paperwork. And you were even seeing home loans with 0% down payments. So you don't got to put anything down. You don't got to show any income. You don't got to show any assets. The bank is going to give you all the money you need to buy a home. And if they're not, you can get a second loan to do that. That way you don't have to put any money down. And the bank's also going to give you a TV if you close by this Friday.
Right.
This was the insane things that we were seeing.
I think I saw that commercial. Yeah, I think I saw that exact commercial.
Right. And so it's, I mean, it sounds funny, but this is the reality of what was going on. So we had risky lending going on, and this was on the consumer side, on what banks did with consumers. Then what happened was mortgage rates went up, and all these people who were on these variable interest rate mortgages now saw their payments double, sometimes even triple. So you went from paying $1,500 a month, or let's go even easier, you were paying $500 a month, and now your payment went up to $1,800 a month. How are you going to afford that new payment when you were going paycheck to paycheck at $500 a month? And so now you said, okay, well, the banker said, let me refinance out of my mortgage and get a lower, cheaper interest rate mortgage and lock it in. Well, home prices started to go down, and now you couldn't refinance. You had no equity in your home, and now you couldn't sell because you had to bring $20,000 to the closing table if you wanted to sell. So now you either walk away or you find a way to pay that extra $1,300 a month. So that was a trigger of the housing market crash. But the real kind of explosion then happened in the derivatives market, because then what happened was banks, which is still happening right now, this derivative stuff is still kind of going on, where banks were, they would take your loans, chop them up, sell them as certain investments. They would market them as these perfect investments, sell them for these high prices, and then they would get insurance against their investments. So it just became this whole kind of behind the scenes, people selling the same investment again and again and again and again and again, leveraging their investments up. So then when the housing prices started to go down, it wasn't just the housing market, it became the whole financial sector, because you had all of Wall Street betting on the housing market, and not just betting on the housing market, but betting on the same deal 10 times or 100 times. And that was just propped up with infinite amounts of leverage. So when home prices started to go down a little bit, it affected the economy 100 times over. And so, that derivative market has not gone away. I mean, derivatives are bigger now than before. I think prior to the 2008 crash, there was something like $700 trillion worth of derivatives in the economy. In 2018, it was something around $1.2 quadrillion of derivatives. So that obviously is concerning, sure. But on the consumer side, things are not the same. Now, that is something you want to pay attention to, because like I said, I like to talk to bankers just to see what's going on. Now, there's no real answer. I just had to say, how's the housing market doing? Are people still buying homes like crazy? Just trying to see like what, how they're doing. And they're very open because bankers love talking about the commissions that they get on selling homes. So, they start talking about it. And what was interesting is we're recording this in October. I think it was September that somebody told me that their variable interest rates are becoming popular again. And I said, what are you talking about?
I don't remember the last time I've seen one.
Yeah. And he said, people were having because when mortgage rates started to go above 3, people were having a tougher time buying a home. And then he said, yeah, I mean, people can get a variable for the first 5 years at 1.99. And I said, you got to be kidding me. Now, obviously, is it as popular as it was before the 2008? No. But that's concerning to me that variables have come back in a sense that some people are starting to get them. And so as mortgage rates start to go up, that's something that I'm going to pay attention to is, are we seeing more variable interest rate mortgages? And if so, how long are their rates? Because, how long are these teaser rates? Because that's something that, you need to pay attention to.
Mm-hmm. Yeah. So obviously very distinct differences between what's going on right now. Obviously, we're not anticipating a crash like that. We don't have the subprime. Banks have learned the hard way. They've been governed much harder since then. Obviously, they don't have the same leeway. They've got reserves now that are required that they did not have those checks and balances back then. So don't see that happening again, but I'd love to kind of lay out those distinctions. So, all right. Well, make it a great day and look forward to talking soon. Thanks, Jaspreet.
Thank you. Take care. It was a pleasure.
Bye.
Bye.
As always, if you like content like this and you want to see more of it, drop a like below. If you're not a subscriber already, please subscribe and hit that bell below. That's a notification button that's going to alert you every time we have new tips, tricks, and strategies that are going to help you move that needle further financially.